Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Thursday, April 24th, 2025. It is 1:11 p.m., so we're a little more than halfway through the trading day and figured I'd just do an update. We'll keep this one limited to the equity markets and the semiconductors, which are very much related. I always say that tech is by far the biggest component of the stock market. It's the biggest component of course, the Nasdaq 100, over half of it. The S&P 500, it's the largest sector by far, at least double the second largest, which is financials. I think last time I checked, 25% weighting in tech. And of course, I always say that so tech is kind of the most important sector as far as the weighting and the performance and the day-to-day returns of the index. And then semiconductors are a subsector of tech. They're the canary in the coal mine, really, if you will, for the tech sector. So we're going to do an update on those as well. Just quick recap. Nothing has changed in my intermediate or longer term outlook. Intermediate, I've been expecting, and we continue to see noise. I keep talking about these daily gyrations, give or take 3% plus or minus a point or so. Another 3% move today. You can fade the rally if you want to fade it. We're at the bottom of the bounce target zone. I replied to a comment. There were a couple of comments today like, "Oh wow, what a big rally! This is just noise. This is where we were. The market's back to exactly where we were over 2 weeks ago, right there on that big rip there. We reversed there, came along to that day, sold there, and highlighted again, reverse back, cover that short, long again. We keep bouncing it off here. All I can tell you is resistance until unless taken out. So on one hand, we did take out the downtrend line, and that is net bullish. There's no other way to spin that as anything but net bullish. However, as I made it reply in the comments section today, you have a lot more reactions. 1, 2, 3 reactions there, another fourth on that level there. Then the breakdown and the rally back to it. So this resistance level, which again is the bottom of the bounce target zone, is more significant, if you will, more reactions than the downtrend line has. But it's just the nature of a choppy market, and I think it's going to continue into next week. As I said, you have the vast majority of the Mag 7, Mag 8, whatever you want to call them, stocks reporting through next Thursday after the close. You have some coming out today, and again, they'll trickle out through next week. So the market will most likely pick its next direction by then. You guys know which way I think that next direction is going. I also chimed in. It wouldn't surprise me in the least if we go up into the upper end of the bounce target zone. And again, I keep saying just above that is really, the 500-ish level. I'm just leaving the box where I drew it before. Comes in with the 200-day moving average. So that's still a max potential bounce target. Let me try to quantify it for you. If that hits, and my plan will not change. You got to have a trading plan. I'm flexible with my plans. I adapt to changing conditions, but bigger picture, nothing's changed. I want to measure. What I have to do is turn this off to try to tell you if we get there, up back to the bottom of that recent trading range around 500 on QQQ. That's about a 7% bounce. It's going to be about 5.5 to get to the 200-day simple moving average, and about 3.5 to get to the 200 exponential. And so let's just talk about the targets too, and the day the market bottomed. The market bottomed on August 7th. And just before that, I was adamant, no more shorts, no longer objective to short. We're oversold. In fact, bounce is more likely. The upside potential is much more likely than the downside potential, even though things could have broken that time, but they didn't, and I didn't suspect they would. So T3 was hit that day on SPY. We also had the comparable T3 target hit that day as well, 480 on SPY. And now let's talk about the futures. I post the futures a lot, trade the futures a lot. So let's go to this chart right here. April 7th. Yep, April 7th was a low. That's this post from that day. Nasdaq futures still in price target zones. And so we'll go to I always put the most recent one down below. And so just to kind of recap, because what I'm doing, guys, I'm not just going back, okay, we got this, we nailed the bottom, and, I'm talking about where we were, where I expected us to go, and that's where we are right now, for the most part. So this was again posted that morning of the when the market bottomed, and you can see my yellow arrows are always my preferred scenarios. That's what I always draw, and I always draw my, if I have an alternative, they're in the same direction. I never, red just says, look, we break it, we're going to go down, hit that, markets are going to break, and we're going to drop, plunge down to that near-term target zone, which is final near-term target zone. I still maintain that, but I have deeper, longer-term targets. So that was, what would happen if we didn't hold in reverse there on support, but we were at support. And again, yellow arrows are an alternative scenario. Solid, as it's stated here, always the primary scenario. And that had us going to right here. It's hard to see in there. That's 19. I had to replicate the levels. This charting platform in particular, the futures haven't rolled, but sometimes if these charts just kind of poof, I can't explain it. Some of the annotations go away, so I went to the daily time frame and I replicate, put all the lines back where they were. If you ever want to replicate, if you can't make out the levels, you can zoom in on these. Maybe not. Well, yeah, in your phone you can pinch zoom. Detail, the resolution's good enough, but you look at the reactions. That's how you replicate my chart or anybody's levels. My support and resistance lines line up with reactions. So that's again. So that's it. Had us going up here to this level right here, which again, I can see it's a little above 19,000. And where that was then, where's the chart I just updated here? One second. Right here. I'm going to zoom in. This is how it was laid out there on the day we bottomed, but I'm going to zoom in a little bit. Let me do it this way so you can see a little better. And so that's it. So that's when that was those long-term targets that I first laid out last summer, last fall in the Nasdaq 100 or QQQ and SPY on my long-term, my weekly charts. Again, the long-term trend swing trader. Hit those charts as is typical. The initial tag of my price targets often produce a reaction. Certainly expect one there, and had it going up to right here. This is that same level, and that's where we're at. We're a hair above it. Day's not over. I suspect we'll fade this rally into the close. That's going to be my plan, and we'll probably park right back on that trend line. So what I've added, the only thing I've added to this chart, other than having to re-replicate the lines again. So again, if they're off a point or two, so you can see again, line up with the reactions. That's it. We're at the downtrend line off the highs, and I still maintain the deeper targets. Now, if we want to get a little more granular, if you will, this is still, remember, on QQQ, and I haven't wavered on those, the bounce target zones. I've had it. This is that topping range, and I could see the potential of us going up there. So again, to reiterate, and that's where right here is where the bounce target on QQQ was. Remember these recent highs. And so somebody said today, big rally. No, but again, this is just noise back to where we were 2 weeks ago, and then again almost a week later on QQQ. Let me go back to that. So I just want to kind of show you where we're at, where we were then, where we are now, exactly where favored us to be, and there it is. Boom, bunch of targets. Reaction highs. And as I've talked about repeatedly, a mountain of overhead resistance. I said to another comment today, it wouldn't surprise me if we go up into my bounce target, possibly all the way to the top. And it wouldn't surprise me if we don't, because we've already hit it. That it's a target zone. I don't think it's that wide, really. They're all the arrows point to the same place. Relatively speaking, you might not want to. I can tell you this now. If you're heavy short, you don't want to ride out probably a 5-6% bounce. You may not want to. And again, that's your thing. If you position too heavy, you're going to feel pain. If you are playing the long game, which is holding out, I keep saying holding out for the prize being T7, which would represent a 50+% drop. We already hit T3, and that's how it works. So, these targets were first laid out last year. We hit T1, a little reaction hit T2. We also covered in reverse there. That rally carried a little bit higher, but not anywhere even remotely close to any reasonable stop. If long-term trading down to T7, you take a a favorable RR, at least 2 to 1 or better, meaning risk a dollar to make 2 or a dollar to make 3, dollar to make 4, whatever your RR is. And so that's it. So we went on, the divergence got even bigger, then we had the trading range we broke out. So that's where we're at, guys. I just wanted to kind of continue to reiterate, we've got a lot of noise coming up this week with the big earnings reports, and we'll see how they go. And so I'll just say it, again, my confidence kind of went back into the active trading mode, and that's what I expected and been talking about recently. The whether or not we go up in here will just depend if the market likes or doesn't like what the Mag 7 are selling. Now, again, it's not all, they don't all report at once. I went over the earnings. You can check the earnings calendar. That's available to you on the right side of the chart. It concludes next Thursday right here with Amazon and Apple. That'll be when those two behemoths are out of the way. That's, there's a couple stragglers with big earnings. NVIDIA's an outlier too with their earnings. They report later, but the rest are all coming up through next Thursday. And you can, play around with their earnings count. There's Microsoft and Meta next Tuesday after the market close. Wednesday. Big tech usually reports after the market closes. Financials usually report before the market opens. The banks, that is. So there it is. A flurry of earnings reports, and about the only thing you can continue to put a lot of confidence in is this kind of volatility. Up today, down tomorrow. Up today, that down tomorrow, that kind of thing. Not each and every day. Someday you have a couple days down, couple days up. That's the reality of where we are. So really, bigger picture. And again, there's been a lot of little micro 15-minute chart trades in between. But this is kind of, that's still to the limits of where we go, and we hit it. We've now hit that 3 times. And if we were to go a little higher, again, you have the bottom of the basing pattern there. You have the kind of the bounce target zone. Again, that's futures. And that should bring us down to the next target, which, of course, I will always align the targets on the futures with those on QQQ and SPY, etc. T4 being the next target that, if hit from where we're at right now, is going to be another 17% downside. Now, let me show you one thing that again, it was already covered, but I want to reiterate it. Something that has the potential. If you're wondering, okay, Randy, why don't you present some bullish information? Show us some bullish analysis. I've always said this. You at just about any point in time, give me a chart. It's like the debate club in high school. I was never on that, but I know what they do. I think they have to pick they get something, they have to defend it one side or the other, and the other team takes the other side of it. Given any point in time, give me a chart. I can sit there and make a bullish case or make a bearish case. And sometimes I will. I'll show you, hey, these are the levels, if broken, are going to just trigger, upside and will be bullish. Just like this triangle pattern. We broke the upside today. You got to take that for what it is right now. Again, the triangle pattern, I'll get back to that in a minute. But, at the end of the day, I always give you my thoughts and which way I think it's going to break and how I'm positioned. And so right now, longer term, like I said, all my arrows go down a lot lower. It's just a matter of, are we going to do this first, or is that about it? So let's talk about the semis. I started out telling you how the semis are kind of the canary in the coal mine. And let's again go back to that was then, this is now. Okay, and right after the market bottomed, and the day of, I believe I'd highlighted here, these were long-term targets. These were targets I laid out last year. Remember, the semis on the market, it made that marginal new high, and I've always talked about the difference. There are times I'm wrong, and there's times I'm early. There's a big difference between the two. Wrong is if I take a trade and it exceeds and hits my stop or any reasonable stop, then I was wrong. Even if it ended up going to where I think it was going to go, to my price targets. Getting in early means you get in, the trade might go a little underwater, but ultimately it doesn't exceed my personal stop or any reasonable stop using a reasonable RR, and then goes on to hit the target. So the stock market is a great example. QQQ made marginal new highs. The targets that are in play now that I've been covering were targets I laid out last year. Now, I also did the same on the semis, and they did peak. So the timing was, spot on there. I gave you 1, 2, 3, 4, 5. I can't blow this up because it's the video, but I covered it that day. We hit my sixth and final target. In fact, as I believe I covered in the video as well, T6, let me get to the live chart. Let me go ahead and play this video. And took the RSI, no, let's do this one. This video goes back to those targets were laid out, and I had the long-term trend line, which I'm going to get to in a second. This is Black Friday. This is back in November. Remember, the semis had long since peaked, and I was waiting for a major sell signal coming to break of this trend line, which we got at the time. So, this trade has been milked. It was, huge drop in the semis, much more than the stock market. I'm going to hit play, and you can just see what was said back then. This is YouTube, doesn't understand. This is the SOXX Semiconductor Index is what I said, and it, obviously doesn't recognize. It's not a very common word to say the SOXX Semiconductor Index, so it says SOXX Semiconductor Index. But yeah, I'm going to show you the trend line I'm talking about. We're going to get to that, and there's a reason I'm doing this. There's a reason I'm looping back. I've highlighted this one and maintain long-term targets on this, bear market targets, all the way down here to T6. So that will be if hit. It's going to ultimately be, the sector will be almost chopped in half, about a 45% drop. We've already hit T1, T2 was a trend line. All right, let me just stop there. All right, so you got it. That's, so I maintained and reiterated, and that was, even if you hadn't shorted that first wedge and gone down, that was still a huge drop to come. That was done again Black Friday, which is when it's at November 27th. And so in that video and other videos since, I covered both these targets here, as well as that long-term uptrend line, which I have. I'll get to it on the monthly chart. That chart I was covering there was a weekly chart. So that was right here. Remember, right after the was it on the daily? Might have been on the daily. Yeah, it was on the daily. I have different boards I use. There it is, right here. Right after that was broken, back test, boom, drop, hit it to the button. I mean, I imagine there's not very many analysts out there, anybody that, from, up here somewhere could list a target that was hit. I had it at 148.19, and we hit a low that day of 148.31. Close enough for government work. I always state my targets are listed at the actual support levels that I see as defined, and I will always cover, almost always cover a short trade before it hits the actual support in case the sellers step in early. Just like on a long side trade, I will always sell a little early if my plan is to exit at a particular price target. Now, where am I going with this? There's a lot to be talked about here. I want to go to, unfortunately, due to this charting platform, they all have their pros and cons. This one you can see the trend line there. There's the long-term trend line. Sometimes the lines get moved. There it is. So on this board, every time they split these ETFs, this charting platform, one of my favorites, go to, but the one downside is they're antiquated. Unlike other charting platforms, they haven't learned how to adjust the trend lines for splits. The horizontal levels stay, no, they get moved too. Anyway, but what I do, and I have done in past videos, is the SOXX Semiconductor Sector Index, and that one doesn't split. This is the first original semiconductor sector out there. Goes back into the 90s. I've charted this one. And again, the SOXX SOXX ETF that we trade, or the leverage variations thereof, which are SOXL for the 2-time or 3-time long, and XOSS for the 3-time short. They track this sector. And you can see that this is a long-term trend line. And this is what we call a secular bull market uptrend line, right? Started back in late 2008. And within that secular bull market, there's been plenty of cyclical bear markets. And these are all drops, high double-digit drops, including this recent one. So my point is, that was one of many reasons we were covering and not wanting to short when everyone thought the world, henny penny, the sky was falling recently. And in there, I need to jump back to that too. Okay, this is the kind of the get ahead of the headline stuff. This is where my background in fundamental analysis and economics comes in where I marry that. And someone said, "Oh, can you not talk about the fundamental stuff in videos?" And again, I welcome the feedback, but no, it's a big part of my trading, and this is why, again, call it right side of the chart, because I'm trying to get ahead of what's about to happen, whether it's in the charts fundamentally or both, because they are very, very, very much melded together. And so what I had said back then, especially once, not if the positive news, but once the positive news on the tariff and or FOMC rate cuts, actual or likely, occurs. So remember, around the time when I was saying no more shorting, we got to go long, we're probably going to bounce, the RR is no longer favorable, it's more favorable to the upside. Long before there was any pivot, even the slightest hint, in fact, things were still getting worse at that point, it was just a matter of time. I said either that was going to happen, and it was just a matter of time, or if it didn't happen soon, if we hit the level like I talked about that day, the very day the market bottomed, this day, I said the system will break. Something will break in the financials, banks, non-banks, hedge funds, something will blow up, and then the Fed will have to come in and either cut or jawbone like they're going to cut, start talking up the potential for emergency rate cuts. So we got the more likely, which I figured was that Trump and the White House would cow down on tariffs. And again, that's the fuel for this. So we position for something based on technicals, but also factoring in the news that everybody's citing today is the cause for this rally. We're at the tail end of it. It's called buy the rumor, sell the news. Smart money, insider traders, there's a lot of insider trading. Some of it's legal as long as it's not, acted upon. Insiders buying is what I'm talking about, and buying their own company stock. You can't, insider trading, passing along things and acting on that. I'm not saying that's legal, but that also happens all the time. So in other words, this is the technical catalyst was already there, and it was also factored in before there was really evidence of reversal other than, the case oversold at support, this is coming, and then it didn't come until now. So now it's starting to come in the masses. 99% of the people out there are now thinking it's a good time to buy because that's came, but they're not factoring in. We're already up. That's at back here. I was calling for us. It was about time I was citing 16% rally was about my target, and that's about what we got. We got it in one day already. The rally of the big day, but I'm going to talk a little bit more about the SOXX here. Okay, so all right, so we're at that trend line. That trend line has been a golden buying opportunity since this trend started back here. If you just bought every pullback to it, you would have been very well. So okay, so why don't we just load the boat here and hold on for the next couple of years? Because that's usually been the trend once you've hit that trend line. Well, great question, and I will answer it. This meshes with everything I'm seeing on the long-term charts. These were just, you can see the uptrend lines, you can see the breaks, and they cause these corrections. And when I say correction, again, double digits. You can call them bear market. They were all those double-digit drops, some high double digits. I'll measure for you just to give you an idea. Back here, we shorted that one. That was a 50% drop in the semis. This one so far was about a 43% drop. The difference between these trend line breaks and these corrections and this one is this one came off a textbook bearish rising wedge. I've done this for a long time, and one thing that never fails to amaze me is these same chart patterns, be it a cup and handle bullish pattern, a head and shoulders, there's a gazillion technical patterns. Wedges are some of my favorites, obviously rising wedges bearish, and bullish falling wedges. Wait for breakout and then go long there. They play out just as well on the long-term time frames. However, you have to understand and define what time frame you're trading on. This is a monthly chart right here I'm on. So this is a big bearish rising wedge that has built over years. This wedge started forming. The divergence started right here back in early 2021. So you have a multi-year wedge pattern that's going to take most likely years to play out and has just gotten started. So we had the sell signal there. Okay, we're at the trend line. So if you are a believer, If you're on the camp that most analysts on TV are, yeah, it's a great buying opportunity. Get in the market, buy Nvidia. AI is here to stay. Blah blah. Buy it. I mean, it was highlighted then. That was my final target. And the final target is the one where you get a decent reversal, and we did. But I addressed it that very day in that last video on the 11th. The reversal came, and it was 26%. Again, that's what was covered in that video I was just showing you. So how much more is left? Well, just like QQQ, I can easily see this much more or not. That may be it. But back to that monthly chart, I want to say, because of this wedge, this is just broken down, number one. Sometimes you break down from wedge, you back test, then you go down. And if that's the case, guys, I will be talking about it if we get up there and back test, right? If we do. It's not my preferred scenario. That's what I do in these videos too. I can tell you, yeah, that can happen. Maybe we just blast right through the wedge and go to new highs. But what I can tell you is based on the projection of this pattern, the measured target, if you want to take the widest part of a wedge, add it to where it breaks down, that gives you a measured target. At minimum, that's going to take us down there. But it's also going to break this long-term secular bull market uptrend line. Now, that hasn't broken yet. When this breaks, when comparable trend lines and things on QQQ and this trend indicator I've talked about so much, one of my favorite, this is what I call the 401k indicator. It is this blue line here, the 20 period exponential moving average put on a monthly chart. It's got to be, I use it on a monthly chart. So 20 period monthly exponential moving average. If you're above it, the trend is bullish and you want to buy pullbacks to it. Key word here, operative word, it's a monthly chart. Nothing, I repeat, nothing matters until the month closes, that candlestick closes. Intra-month breaks are very common. So you want to look and see how did it close the month. When you zoom in there, and those two I just poked at here, circled, that one, you were way below it intra-month, only to rally and stick save and close back above it right there on that month. Same the following month. You were below it and you closed solidly back above it. So if you look at and stay away from all trend indicators, including this one in choppy sideways market. So we're not going to look at this period here because that was an obvious grinding market. You're going back and forth. The semis were in a multi-year sideways pattern. But if you look at each and every month, that one goes back to the dot-com bubble. We'll zoom in nice and tight so you can see it there. Your first solid monthly close was right here. So let's just say you had the discipline to wait to the end of the month. That's where it closes. A red candle means it closed at the bottom of it. You shorted there, or you sold your longs. Let's say you were buying in, just like all the lemmings are right now to this AI bubble. You were buying into the dot-com bubble back then, the hype. But you said, you know what, I'm going to go with this indicator. I'm going to sell all my dot-com crap. You just sidestepped, saved yourself a 71% loss. From, again, not shorting the highs. You shorted the highs, you saved yourself from an 84% drop. But if you waited to that sell signal, or like me, you're a flexible trader, you go long or short, you turned around and shorted, you would have made enormous profits, more money in a year or two than most people make over a decade investing. And again, I love this trend indicator. It's simple. When you're below it, you're in a bear trend. Short rallies back to it, or exit longs if there were reasons, which there would have been plenty of. 15-minute or 60-minute charts, daily charts, to go long the counter trend bear market rallies, which are explosive. This is why most people don't trade bear markets. This is why I do these long-winded videos, to try to let those, see why I keep the faith right here. Is, I like days like this. I expect days like this. We can have a few more days like this and take us up to the top of the range. It doesn't mean the bear market's over. The bear market rallies, again, are explosive, and you can make more money in trading bear market rallies, even if you don't short. Just wait for the bear market rallies, trade on the long side, than you make in a bull market, because bear markets are like bull markets in fast forward with the fast forward button on 3-5 times speed. Things go up a lot faster because you have a combination of dip buyers stepping in and shorts getting squeezed out, covering their short positions. And that's what causes those super powerful rips, again, like that 84% counter trend. That's all it was. And again, if you just stuck with this indicator, look how beautiful these are. All those back tests. And then when we popped it there, hold up, don't jump the gun. That was intra-month right there. You close right back below the line right there. The following month as well. So Again, guys, I'm giving you things I've learned over the years. I'm not going to call it the holy grail, but it's a very, very reliable indicator and it factors into my analysis. I've talked about it just recently too on the monthly chart, SPY and QQQ. We need to see what happens at the end of this month. Same with SOXX. So that was, I showed you the golden entry there to milk that bear market back in the dot-com bubble. Then the financial crisis. Let's zoom in one more time because I'm not going to pick just one example and, kind of brush away the others. So you were flirting on it. That was a whipsaw. There's no perfect indicator, but remember we were also in that choppy trading range. Here you really had a nice hammer down. There were a lot of reasons. I was shorting at the top there, saw that bear market coming, gamed it with impunity back then, and there was plenty of reasons. And here you can see this was just hugging the line, a lot of whipsaws in a sideways trading range. Here you started to get away from it. Again, there were a gazillion and one reasons to sell signals that came on the Nasdaq 100 and S&P 500 back then as well that would have got you short the semis and told you that this trend, that sideways range was probably going to end. And either way, look at that beautiful back test. Boom. If you shorted that back test, because let's say you saw this range, you didn't want to commit anything long or short to the semis, but at that point it was clear we were in a bear market and you were given a gift on that first big bear market rally. And had you shorted that, there was a 61% drop from there. And then, as you can see, you recovered it. There was some whippiness. That was one close below there. But for the most part, that was your first recovery candle. And that green one, you stayed above it, above it, above it. There was one little whipsaw, but even if you followed this religiously the following month, you closed solidly back above it. It said, get back in. That was a bear, trend. Choppiness there. Again, no trend indicators perfect, so you're going to see some candles. You were whipped in and out there. And again, the semis, there were better fish to fry. This trend indicator, like all of them, works best in trending markets, both clear bull trends and clear bearish trends. And so that's where we're at. Oh, let me show you where we're at now. The last bear market, that's when you gave up the ghost. Rejection, or back test, breakout. That first green candle closed above, and then every single candle for the next 1, 2, 3, 4, 5 months successfully kissed it, back tested, kept the trend going, kept it going there, and then look, last month, sell signal. So I know I just spent a lot of time talking about something. I want to make very clear what I see, and this is what I see elsewhere. I see this right now in QQQ. Right now, like I said, this month, I told you, and SPY, I need to see if this month, if we get a solid close. And that's going to look, there's not a lot of real estate left in the month. Today's the 24th. Let me pop my calendar back up here. The last day of the month is the 30th. So, yeah, we're not going to have some of those other big fangs are going to report right after that. So we'll see, guys. I'm just keeping it open right now. So this will make a big, and the semis kind of do their own thing. But again, the semis are, kind of the canary in the coal mine for the tech sector. So they're going to close the sector the month. Well, they already closed below their last month. Here's SPY. Again, we're in very close proximity. So if the market dumps hard between now and next week and we get those confirming sell signals, that will be the first time on SPY and QQQ. Again, I'd like to see both happen since right here you can see we were falling down to it, close right on it that month. That month you didn't have to blink to see clearly close below it, then back tested from below, back tested. Remember, only look at the fat part, the candlestick bodies. Those are all that matters, And so we were below there, and that was the latter half of that bear market there. So those are some of the things I'm watching, and that's kind of bigger picture stuff. Near term, like I said, in a volatile market, if you're trying to aggressively, trend position short for those long-term prizes, you just have to know that you're going to have these counter trend bounces. And like I said, we could easily go 5-6% higher and still well be within all those technical levels, the resistance levels I showed you on the daily charts. Or not, because we've already hit, this is the third time in just over 2 weeks that we've hit the bottom of my bounce target zone on QQQ. So a lot of overhead resistance. Kind of like I said, mixed bag. Just to kind of loop back to the chart I've been sharing right here. I've been sharing the 60-minute, and this is just a similar version, 2-hour candles instead of 60-minute candles. And so we did, yeah, you have to recognize we took that out. Yesterday, the breakout failed. We went right back. I had 2 lines for you right here, pullback targets. That was that gap. We hit it. So in overnight trading, you would have made 2-3% on the pullback there, whatever it was from yesterday's high. And we're right back. We're smack in the middle. This is that same resistance zone. This is where, back here when we bottom, that's where the arrow had us going price-wise. Now we've hit. We keep hitting it. We go up there. Yeah, we could go up there, and that's there's the bottom of the basing pattern right there. So that's about that comparable level on QQQ, that bounce target zone, BTZ we'll call it, which is right there. So, all right, I just wanted to show you what the semis are doing and the longer term outlook, because like I said, normally you hit a trend line like we did in SOXX, that long term trend line on the monthly chart. Where'd it go? No, SOXX. Dash 2 dashes SOXX dash X. That's the primary uptrend line. We just kissed it. I have 2 variations. I have this one right here in white comes off. I capture these lows right here, 2 lows, that one, and so that's it. And based on the wedge, this is a trend line that has worked so well for years now, actually over a decade. All the way back to 2009, buy, all pullbacks. And that may continue, for new highs for the foreseeable future. But based on everything I see in the charts, the big divergences that we never, ever had before, these were just trend line breaks that gave us these nice drops. And then the same thing, guys, on QQQ. I mean, the same exact thing. Again, I've covered this quite a bit, but bears repeating. This shows you all the drops back here. I've covered this chart so many times in the past. These were all the corrections that came with, I'm trying to remember where those were measured. I used some metric on here on this chart. I'm trying to recall. Forgive me on that. But either way, this is the primary uptrend line right here. And again, no trend lasts forever. And it's not just this. And I need to be clear to new subscribers. If it was just this, just another divergent high, and they do work. These are all divergent highs right here, drop, big drops. That was the last bear market right there, the 55% drop after that trend line break. These might be, and you can see also the 20-month exponential moving average. I already covered that actually a second ago. But this is the primary uptrend line on QQQ. And one of, other than the big negative divergences, which we haven't seen divergences like this really at all in QQQ. You got to go back longer. You can go to the Nasdaq Composite or NDX. QQQ is an ETF, so it just started trading back in the late 80s. But it's very, very, very much this as well from a fundamental perspective. TNX, the 10-year Treasury bond, and TYX, the 30-year, showing that they were in a secular bear market, falling interest rates, which is very bullish for stocks. And it is anybody that knows finance investing, this isn't debatable. It's unarguable that was the catalyst for the supersized bull market that some of you have only been born knowing. And this is a very big secular trend. And that trend ended by every metric that I have on my charts and technical analysis. So whether we have a big pullback or not, just about everything shows that trend is over and we're entering a new era of rising interest rates, hence those very aggressive targets, and hence the fact that I would expect and completely do expect those trend lines that I just showed you, these major trend lines. This is the NDX, the Nasdaq 100. This one we can go back a little farther, like 80s, and you can see again, here's your uptrend from the 07 lows. I have 2 variations of the trend line right there. And this is major support. That's a target that I believe will be hit as T2 will be hit. And then ultimately this longer term primary uptrend line and or this level here. And that meshes with the targets I gave you on QQQ. Actually, that one's a little more aggressive. That one, that's my longer term target. And this is the probably where we're going to go roughly with T7 on QQQ. Okay, so like I said, keep an eye on SOXX. Let me go back because those trend lines got shifted on the split. Remember, just like SOXX, let me go to a daily here. We already hit T6 and the trend line. Both were long-term targets laid out in those previous videos. Going back from last year, again, those targets weren't laid out when we started going down here. They were laid out well in advance and hit it almost to the button. And now the thing is, how far do we bounce? Well, one thing you can do is put up Fibonacci retracements. You'd be surprised how often they work. It's not a clean board, but either way, I just did it there. Here's I'm going to highlight these for you. This is at 38.2, and I measured the move from the highs. That's certainly, and look where that lines up. Perfect with my T3. Again, I just put these fibs up. I hadn't done this before. If the Fibonacci's go from the high, and they measure this entire drop to my sixth and final, really what I call, it's a long-term but initial long-term target. Again, expected a nice bounce. It's been a pretty good bounce before. This right here is a very logical target. If the semis carry up, it's a very good level. Again, it's a level I laid out over a year ago, last year, when the semis, before they peaked or right after. And then whenever I laid these out, when did I do that? Initially created back on August 21st, 2024. So right here, August. So right after the top start was in, I give you the long-term targets. We already had a sell signal there. And that's a perfect alignment with that T3 level, which is very good support. I didn't pick T3 randomly. Remember, this before we got here and had that reaction off T3, it was put there for a reason based on the chart. So now you can see how well it lines up. And I'm going to see this 50. I'm going to add a line right now and tell you that is also a potential bounce target if the semis get some traction here. So I'm adding a new line right now, and it lines up perfectly, that 50% retracement with, see this reaction high? That was where we bounced to. See all these reaction lows? This was a support shelf that was broken right here. We went down, we hit my third target. By the way, that was T2. That was T2 already. So I just put a line where I already had one. T2 was already hit. And that lines up with the 50% Fibonacci retracement level right there. So there's, if we can get a little more upside, that's a potential bounce target. But I'm going to put the whole bounce target zone here because that aligns up with QQQ. Remember, QQQ already is at and has hit now for the third time that bounce target zone. So there it is. And it's a pretty wide target zone. But look what's at the top of it too, guys. Let me turn off the lines. This is just beautiful. The charts are right now just so clear. This is the 200-day exponential and the 200-day simple. Those lines often define bull and bear trends. The semis are more volatile. They're like the Nasdaq 100 on steroids. They're the GDX to gold, if you will. They move the same direction, but more in percentage terms. And so you often overshoot the 200s to the upside and downsides, but ultimately it's that momentum-fueled overshoot I talk about where you come down, shoot through a support level, but then snap right on back through it. And so they're up there. And you can see once we took them out here, we clearly took them out there and we started back testing, rejected. So, you know, if this rally has some teeth, yeah, we can get all the way up there, and it's just going to take us back to previous targets, which were support, and support once broken becomes resistance. All right. And so, yeah, it's a pretty big area. It's a little fuzzy. What does it mean to me? You know, on the long-term position, still scale in time. It's not bet the farm heavy. I told you that recently. It's where I started to and will continue to add to short exposure. And if we never get any higher and we start to reverse, when I feel like I'm confident that the reversal's in, I will continue to add too. So I'm either going to be adding back to my long-term swing shorts on strength in the market, which is the same as weakness in those positions, or the other direction. But we'll see. Right now, it's just too fuzzy near term. This is it. Up today big. Probably, I think they'll dump it into the close because we're at resistance again, profit taking. Who knows? Maybe, maybe not. Today has all the makings so far of a trend day. A trend day is where you open up and continue higher all day into the close. It just depends how many more shorts need to be squeezed out. That's the big thing. A lot of, traders probably, it's still buying SQQQ and those index short ETFs, and they need to get squeezed out. So it's hard to say. So again, my near-term confidence in the direction, choppy, swing trade, active trading. Longer term hasn't wavered. You have a relatively small window, if you will. And then anything much more than that, then hey, I have to reassess things. Maybe that those longer term targets aren't going to be hit, or maybe they're going to be hit later in the year or next year after the market makes a run at the previous highs. I don't think that to be the case right now, not even close. But if we start to take out the top of my bounce target zones, take out the 200 days for more than just a brief pop through, then I need to reassess things, and I will do so at that time. All right, this has been Randy Finney with Right Side of the Chart. Have a great day.